Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Frontier Communications parent Inc. quarterly report. Frontier Communications offers a wide range of businesses and services to its customers. These include data and internet services, broadband internet, Ethernet, dedicated internet, software-defined wide area network, managed Wi-Fi, traditional circuit-based data, and optical transport services, wireless broadband services, voice services. Data-based voice-over Internet Protocol, unified communications as a service, long distance, and voice messaging services, video services. Frontier TV brand and satellite TV video services, switched access services for other carriers to use its facilities' hardware and network solutions, utilizing cloud functionality, third-party communications, equipment bundles services. The recent increase in Frontier Communications Parent, Inc., FYBR, stock price can be attributed to several key developments. The acquisition by Verizon, announced in September 2024, has been viewed favorably by analysts, contributing to the stock's growth. Additionally, the company's strong fiber subscriber growth, accelerated fiber broadband revenue growth, and increased adjusted EBITDA have all contributed to the stock's rise. Frontier's ability to exceed consensus estimates on revenue and its strategic fiber network expansion have also positioned the company for future success. As a result, investor confidence has grown, with the stock reaching 52-week highs in both September and October 2025, leading to an increase of over 5% in the past year. The primary drivers of revenue growth or decline can be identified through a review of the financial summary. Revenue growth is primarily driven by data and internet services, fiber broadband customers, contracts with customers, and secured fiber network revenue term notes issuance. On the other hand, revenue decline is attributed to voice services, video services, copper broadband customers, losses in traditional video customers, and decreases in consumer average revenue per customer, ARPC, due to declines in voice and video services. Subsidy revenue exhibits a mixed trend. Net income and profit margins. A shift in trends. The financial summary reveals a mixed bag of results for net income and profit margins. On one hand, the 3 months ended September 30, 2025 saw an increase in net income by $31 million compared to 2024. However, this trend reverses when looking at the 9-month period, with a decrease of $30 million from 2024. Profit margins also show contrasting results. The operating margin for Q3 2025 improved significantly to 7.5%, up from 5.8% in 2024. Conversely, the YTD 2025 operating margin declined to 5.1%, down from 6% in 2024. The reasons behind these changes are attributed to increased depreciation and amortization expenses, pension/OPEB special termination benefit enhancements, and other adjustments. Additionally, a net current period other comprehensive loss of $14 million likely contributed to the decrease in net income. These factors highlight the complexities of financial performance and the need for ongoing analysis to understand the underlying trends. The company is indeed generating a significant amount of positive operating cash flow. According to the financial summary, net cash provided from operating activities reached $1,500 million in 2025. This trend continued throughout the year, with the company maintaining a positive operating cash flow of $1,500 million for the 9 months ended September 30, 2025. As stated on page 57, the company's operating cash flow is indeed positive, indicating a strong financial performance and ability to generate cash from its core operations. The company's debt level and interest expenses have undergone significant changes. The total long-term debt has increased from $11,569 million to $12,044 million, while the debt level has risen from $2,500 million to $5,500 million as part of a 2024 credit agreement amendment. Additionally, the revolving facility was increased from $900 million to $925 million, and the term loan facility's maturity date was extended for $1.025 billion of the loan. Interest expenses have also changed significantly, with some periods showing decreases and others increases due to higher debt balances or interest rate changes. A 100 basis points increase in the SOFR would result in approximately $15 million of additional interest expense. Overall, these changes indicate a notable shift in the company's financial obligations. Management is optimistic about the company's outlook, driven by a strategic focus on building critical infrastructure through fiber optic networks and cloud-based solutions. The goal is to support a digital society, close the digital divide, and promote sustainability, building Gigabit America. Key drivers of growth include expanding and transforming the fiber network to meet increasing demand from consumers and businesses. Fiber revenue is expected to continue growing, while copper revenue declines as customers migrate to faster, more reliable fiber connections. The company's decision to limit new subscriber sales of traditional TV services in favor of broadband products and OTT video options has also positively impacted data and internet services. However, management acknowledges uncertainty around the BEAD program and potential changes to broadband infrastructure requirements, which may impact costs and compliance. Additionally, increased regulatory challenges in the video programming industry due to privacy-related legislation are a concern. Despite these challenges, management remains focused on managing debt and maintaining compliance with credit agreements. The company has a history of paying out dividends to its shareholders. This is evident from the explicit statement on page 26 that reads dividends paid. Concerns about inventory buildup or supply chain disruption are indeed present. Several factors contribute to these concerns, including inflationary pressures, potential disruptions from trade tariffs or disputes, and various external events such as epidemics, pandemics, natural disasters, economic instability, and wars. These risks can lead to supply chain delays, increased costs, and even the imposition of trade tariffs, ultimately affecting inventory levels and overall business operations. That concludes the financial summary for Frontier Communications parent Inc. Feel free to comment below, and I will be happy to answer them when possible.